Okay, well, thank you everyone for joining us for this workshop, Keys to Home Buying. A quick intro before we get started. My name is Chantel Fournier. I'm the Assistant Vice President of Mortgage and Business Lending here at Maine Family Federal Credit Union. Today, we'll be walking through the steps home buyers take from preparing to purchase a home to working with a realtor and lender to searching for a home and making an offer. We'll also cover what happens after your offer is accepted and on closing day before wrapping up with some keys to successful home ownership long term. Making the decision to purchase a home is an exciting but potentially overwhelming time. Houses are typically the largest person many people make, so you want to be sure you're prepared as you enter that process. The first thing you want to do is work on gathering the documents you need when working with a mortgage lender. Exact documentation needed may vary, but typically includes 1 to 2 years of W-2s and tax returns, at least 30 days of consecutive pay stubs or other sufficient proof of income, and at least 3 most consecutive months of bank statements, as well as statements for any investment or other assets that you have. If a relative is gifting you funds towards your home purchase costs, they'll need to write a letter guaranteeing it is a gift and not a loan from the individual to the home buyer. You may also be asked to share proof of rental payment history, such as clear checks and your landlord's contact information. Once you have gathered all your documents, use them to determine and create your budget. Start by reviewing your income and determine your net income, which is the amount of money you actually take home after taxes and deductions are subtracted. It's important to work with your net income when determining your budget because lenders work with your gross income and do not consider all of your monthly debts. We'll touch a little more on that a little later on in the presentation. Next, list all expenses. Use your statements to review spending and determine actual amounts for each expense category you have. It's helpful to look across multiple months and find an average as expenses can vary from month to month. Your goal here is to have a solid understanding of where every dollar you earn goes so that you know how much money you can afford to spend comfortably on a mortgage payment. Once you have developed this list of expenses and developed a budget of how much you estimate and would like to spend on each expense category, spend a month or two tracking your spending carefully to ensure you have captured all expenses accurately and confirm you're comfortable with the budget you have developed. This will be a key step in determining how much money you can truly afford as you start looking at homes. It may also be helpful to look at a full 12 months to determine any expenses you have that are on a quarterly basis or an annual basis, like Sam's Club membership or your Disney Plus subscription. Your credit score is more than a number. It's a snapshot of your financial habits. It's built from several key factors that show lenders how you've handled credit in the past. Let's take a closer look at what goes into that score and why it matters. First is payment history. It's the largest factor of your credit score. This shows lenders how you've handled your current and past monthly obligations and is a key indicator of your ability to repay in the future. Your available credit, 30%, which is the amount you owe compared to the total available credit amount, is the second largest factor that impacts your credit score. Keeping balances low shows lenders that you can manage credit without relying too heavily on it. Most lenders recommend keeping utilization below 30% to maintain a healthy credit score. Length of credit history at 15%. Opening new loans or lines of credit will bring down the average age of your accounts and may temporarily lower your score. Closing accounts can also lower the average age of your accounts, especially if it is a long-established line of credit. Your credit mix makes up 10% of your credit score. Having a good mix of installment loans, such as home and auto loans, and lines of credit, such as credit cards or HELOCs, can help improve your score. Finally, the amount of new credit you have can impact your score. It's also recommended to review your credit reports as soon as you start thinking purchasing a home may be on the horizon. You can review your credit reports from all 3 credit bureaus, TransUnion, Experian, and Equifax for free once a year at annualcreditreport.com. You can also monitor your credit daily with Savvy Money, a tool built directly into Maine Family's online and mobile banking. Savvy Money allows you to actively track your credit, set goals, and use a debt-to-income calculator to see where you stand before applying with a lender. Reviewing all three reports is important because some creditors may not report to all three bureaus, so information can vary. Reviewing all three reports will also help you have a clear picture of everything reporting under your name. If you find any errors or inaccurate information, file a dispute with the credit bureau directly. This process can take a bit of time, so the sooner you can start the dispute process, the better to avoid holding up the mortgage application process. If you have negative items on your credit report that are legitimate, those will not typically be able to be successfully disputed. You can, however, add a notation to your credit explaining the negative items, especially if there was an emergency or situation out of your control that led to accounts falling past due. This notation will not impact your credit score or remove the negative item, but it can give some context to the mortgage lender reviewing your credit to take into consideration. We'll take a pause, check in with Rachel if there's any questions so far.
We do not have any questions so far, but I just wanted to mention that we will be following up with an email that has links to all of the things that we're talking about in this presentation. So you'll have all of that just a click away.
Thank you. All right, once you've laid the groundwork and are ready to start taking some concrete steps towards finding and buying a home, you'll want to find a realtor and lender to work with. These individuals will be guiding you through this large purchase, so you want to be sure you trust them and feel comfortable working closely together. When looking for a realtor, it's a great idea to start by asking friends and family in your area who they have had good experiences with. Just as important, be sure to find out if there is anyone you know who has had a negative experience with a local realtor. You can also search online for recommendations of local realtors in your area. Be sure to read reviews carefully and do thorough research before making a choice. Consider interviewing a few realtors to decide on who is the best fit, especially without personal recommendations from families or friends. As you research and interview potential realtors, it's important to make sure they have proper credentials. Of course, reputation is important, and you will want to be sure they have the proper expertise to guide you through this process confidently. Do they know the market you plan to buy in? If you're looking, up north or inner city, just make sure it's somebody that's familiar with that area. In addition to finding a realtor to guide you through the process, you'll need to find a lender to help you finance the purchase. Start your search by meeting with a mortgage department at Maine Family. We are a lender you already have a relationship with and trust, so it's a great place to start. If you want to search around and compare rates across a few different lenders, get all your ducks in a row and submit your applications within a short time period to limit the credit impact. If applications are spread out over several months, you may start to see your credit score drop due to multiple hard inquiries over a longer period of time. If the inquiries are close together, ideally within 1 to 2 weeks, it will be obvious you are rate shopping and you will not have the same negative impact on your credit score. It's also a good idea to ask these potential lenders if they have a minimum credit score requirement and if they do a hard inquiry or a soft inquiry with pre-approval requests. Hard inquiries impact your credit score while soft inquiries do not. Before starting your home search process by looking at specific homes, apply for a pre-approval. This will help you know for sure how much financing you'll be able to get so you know what price range to search within. It's important to get pre-approved before looking at homes to prevent the deep disappointment of falling in love with a home that is outside of the price range you will be able to get a mortgage for. It can be exciting to start looking at specific homes, but don't skip this step. A pre-approval means that the lender is tentatively willing to finance a mortgage up to a certain amount. This is not a guarantee that you will for sure be able to get this loan, but it lets buyers know that you have started the process and have reason to believe you should be able to obtain sufficient financing when you make an offer. This can be a leg up if you place an offer on a home that already has multiple offers. A pre-approval gives the seller confidence you're likely going to be able to move forward to close. Final approval will come after you have found a specific home and move forward with requesting a mortgage for it. When seeking a pre-approval, it's important to first understand what you can comfortably afford within your personal budget. Lenders do not typically review all of your everyday living expenses, so you may be pre-approved for more than what feels manageable month to month. Before applying, take time to determine both your overall comfort level for a home purchase and what monthly mortgage payment fits your budget. Share this information with your lender upfront. Just because you're approved for a certain amount does not mean it is the right amount for you. Lenders primarily focus on gross income and reported debts and do not factor in expenses such as groceries, utilities, or subscriptions. This is why having a clear budget is essential. It helps you ensure your home purchase supports long-term financial stability. You will also need to be prepared with sufficient savings for down payment, closing costs, and other upfront expenses that can vary depending on how much you are purchasing the home for. This will also be important to consider when determining for sure what price range you can afford to search for homes within. Down payments can vary from 0 to 20% of the sales price depending on the loan product you are eligible for. And finally, it's important to know that your property taxes and homeowners insurance, which are typically included in your mortgage payment, are likely to change over time. When figuring out what monthly amount you are comfortable spending in your budget, be sure there is wiggle room for that payment to increase without causing strain. This can happen as soon as the first year after buying your home. We'll talk a little more about what an escrow account is later on in the presentation. And I think this is time to pause for questions again.
I have two quick questions. The first is, how far in advance should you get a pre-approval letter from your lender?
So may depend on the lender specifically, but with us, pre-approvals are good for 90 days. So if you think you have all your ducks in a row and you're ready to start looking at houses, talk to a lender and get that pre-approval. Your realtor is going to want it before they actually start showing you homes.
Okay, that answered the second question, is how long is the letter good for? So 90 days, perfect. And that's all we have at this point. But again, don't be shy jumping in with any questions that you have. We will answer them at the end of each of these sections.
Perfect. All right, once you have chosen a realtor to work with and have identified the price range you're comfortable with and received a pre-approval from at least one lender, now it's time for the fun part, searching for your home. It's unlikely you'll find your perfect dream home that checks every box on your wish list, so it's important to think about what are non-negotiables and what are nice to have features, but are things you're willing to budge on. Choosing a location is one of the first decisions you will need to make as you start your search. What neighborhood would you like to purchase in? Do you have or plan to have a family? What school district would you like to be in? And how close do you want your school to be to the kids or to your school your kids would like to attend? Are you going to drive 30 minutes to bring them to a school? Are they going to be able to hop on the bus and it's 10 minutes away? How far from work are you willing to live? Are there public transportation options that can get you to work easily if this is really important to you? And what are property taxes like on average? Taxes can vary significantly in some areas. If the property taxes increase or are higher than expected to begin with, it could break the budget as it may lead to a mortgage payment that's out of the range you're comfortable spending, even if the purchase price is right. Also helpful to think about what other places you frequent and determine how close to or far away from them you would like to live. Consider what other things you would like to live near, like parks, libraries, grocery stores, public transportation, and anything else that is important to you. And finally, when choosing a location for your new home, it can be helpful to look into things like noise and traffic levels, as well as safety considerations. When I was recently in the market to purchase a new home, I found a home that seemingly checked all of the boxes until it got down to location. The home was located on a high traffic main road. You could hear the traffic from inside the house, not ideal for nap time. And it drew concerns for letting my dog outside or kids playing in the yard being that close to a busy road. It's also important to keep in mind whether the property has a generator or how likely you are to regain power quickly during storms. If you're on a private dirt road, you may want to ensure you have a generator and the proper hookups, or consider getting a little closer into town. Beyond location, you will also want to identify what needs and wants are. Start by considering things like the number of bedrooms and bathrooms, what's an ideal number, and what is a non-negotiable number to meet your needs. You may also want to think about square footage needs, as well as what style of house you are interested in pursuing. A single family home, duplex, townhouse, condo, 1 or 2 stories. You may also want to consider the aesthetic and floor plan styles you like as well. Do you love to be outdoors, dream of planting a huge garden, or to have room for your kids and pets to run around freely? Outdoor space is another thing to consider. What is a need and what is a want? The kitchen is another key thing that many people have needs and wants related to. Take some time to determine what you need, what you want, and what you may be willing to compromise on, but could potentially modify later. What other features of a home are needs for you and your family? Identify these non-negotiables and share them with your realtor so they can help you search for homes that meet your needs. And another pause for questions.
We have one question. If you can just talk a little bit about the benefits for first-time home buyers.
Yeah, so there are lots of grants available, down payment assistance programs. There's tons of resources and courses out there for first-time home buyers. I believe there's even a first-gen assistance also if you're the first one in your family to purchase a home. It's all about doing some research, maybe talking to your lender to see if they have specific connections. I believe in our links that we're sending out also, some resources there for homebuyer education as well.
And that's it. And yes, we do have some nice checklists. We have some calculators in the follow-up that are going to help you determine whether you should rent or buy a home. We have links to your credit report and all kinds of all these other different things that will help you in the process of figuring out whether or not you're ready to purchase a new home.
And I can make sure Rachel has the link to the home counseling classes as well. Once you find a home that meets your needs and hopefully many of your wants, it's time to make an offer. When determining what to offer the seller, you'll want to consider the purchase price you would like to ask the seller to agree to. Your offer can also include any contingencies you may want to include, which can range from agreeing that the buyer can bow out without consequences if the appraisal comes in low or the inspection indicates drastic repairs, to agreeing the buyer has time to sell their current home before closing on a new one. The buyer may also want to request certain concessions from the seller in their offer, such as a seller covering some of the buyer's closing costs and reduce the amount of cash a buyer would need to close. There are limits to the percentage of costs a seller is allowed to cover, so be sure to talk this through in detail with your realtor. Your offer can also include when you'd like to close on the home and move into the property. You can also provide the buyer with a deadline to respond to your offer, as well as indicate how much money you are willing to put down as an earnest deposit. This indicates to the seller that you are a serious buyer and plan to move forward with the purchase, giving them reason to confidently remove their home from the market. Any earnest money deposit you put down goes towards your closing costs or down payment at the time of purchase, reducing the amount of cash you need to close. The earnest money deposit is typically 1% of the sales price. But again, that's a good question to ask your realtor. Making an offer when it is extremely important to have a realtor on your side that you trust and assist you in preparing the offer. Any questions?
No questions for this section.
Perfect. Once you've submitted an offer on the home you're excited about, hopefully it will be accepted by the seller. There may be some negotiation which you will work with your realtor on. Once your offer is accepted, there are some important steps to take to close the deal. The first step is to actually fully apply for a mortgage with the lender of your choice that pre-approved you. There are a variety of mortgage types available, and your lender can help you determine which might be right for you. A conventional mortgage, this is what we offer here at Main Family. FHA mortgage, if you're a veteran or active duty service member, a VA mortgage, USDA mortgage. When applying for a mortgage, you may also be offered a fixed rate option and an adjustable rate option. A fixed rate mortgage means the interest rate will remain the same for the life of the loan, while an adjustable rate mortgage may change over time. We specifically offer fixed rate mortgages here at Main Family. One thing that can be helpful to understand is the difference between APR and interest rate. The interest rate is the percentage you are required to pay to borrow the money for a period of time. The APR includes the interest rate, but also adds in other fees you will pay the lender in order to better represent the total annual cost to borrow this money. Comparing APRs when choosing a lender can give you a better idea of the more affordable option compared to looking at just interest rates. While it is possible to get a mortgage with less than 20% down, you will typically be required to pay for additional insurance that protects the lender because they are taking on more risk by lending you more of the home's value. If something were to happen and you were to default on the mortgage, the lender is at a higher risk of loss. This insurance is called either PMI for conventional loans or MIP for FHA loans. PMI, which is short for private mortgage insurance, is typically required if you obtain a conventional loan with a down payment lower than 20%. And mortgage insurance premium, known as MIP, is required for all FHA loans, regardless of how much money you put down. Typically, your monthly mortgage payment includes four main components: principal, interest, taxes, and insurance. We just talked about one form of insurance, but you will also need homeowner's insurance for any mortgage and will have property taxes to pay as well. While property taxes and homeowner's insurance are typically paid out once a year, you can pay towards that annual amount on a monthly basis as part of your mortgage payment. This goes into what is called an escrow account, which your mortgage company will hold onto and then use to pay your taxes and insurance premiums when they come due for the year. Once a year, your lender will review the escrow account to determine if a sufficient amount is collected to ensure the taxes and insurance can be paid on time. They'll send you a notification letting you know if your mortgage payment will increase or decrease to maintain future payments. It is important to know this can happen as soon as the first year so you can be prepared for this possibility. When determining whether or not they can extend a loan to you, underwriters look at a variety of factors, the first of which is capacity. Do you have the ability to repay this loan if they extend it to you? Underwriters will review your income and employment history, how much money you have in savings, your current monthly debt payments, and other financial obligations. They will review how the requested mortgage payment fits in with this to ensure you are likely capable of financially managing all of your obligations. The second factor lenders look at closely is capital, whether you have cash reserves or assets available to cover your payment in case of an emergency. This demonstrates financial stability and shows that you have the ability to save or invest on a regular basis, further supporting your capacity to manage a mortgage payment. The next thing underwriters will consider is your credit history and score. This will indicate to a lender how you have managed accounts previously, as well as how you are currently managing credit accounts, to indicate how risky it is to them to extend more credit to you. The higher your credit score, typically the more options you have available to you and the better rates you will get. While it is possible to obtain a mortgage with a lower credit score, it is in your best interest to get your credit score as high as you can before applying for a mortgage. And finally, underwriters are interested in the collateral. You are pledging on this loan. For most mortgages, this will be the home itself. The underwriters will want to ensure the home is worth enough to cover their losses if you were to fall behind on your mortgage so far that they need to foreclose. That is typically determined through a home appraisal. Once you submit a complete mortgage application, you will receive a loan estimate within 3 business days. This document is not an approval or denial, but rather a detailed outline of your proposed terms, costs, and expectations. It's designed to give you the information you need to decide whether you would like to move forward with the loan. This can include the estimated interest rate and whether or not that can change throughout the term of the loan. The estimated monthly payment you can expect includes estimates for the portion that will go to taxes and insurance, and the estimated amount of closing costs and the estimated total cash you will need in order to close, which is typically need to be paid by wire transfer or cashier's check on closing day. The loan estimate includes key details about your loan, such as whether you're paying points to lower your interest rate. It's important to review the document closely and make sure you understand everything before proceeding. After your loan application is submitted and approved, the next step is a home inspection. Home inspections are not typically required, but are highly recommended. A home inspection is for your protection as the buyer. It's to help you enter the purchase with a clear idea of flaws or warning signs in the home. You as the buyer will choose a home inspector, so be sure to shop around for one you can trust. It's also important to note that you are responsible for the home inspection costs, which can cost $500 or more. Be sure to include that in your budget as well. When you made your offer, you may have included contingencies related to home inspection findings. If an inspector shows a major issue with a system or a large repair is needed, you may be able to negotiate with the seller to ask them to fix it, reduce the purchase price if you'd prefer to fix it yourself, or you may have the right to cancel the agreement to purchase the home if you're dissatisfied with the inspection or cannot agree with the seller on resolving concerns. This is something to talk with your realtor about in detail when submitting an offer to make sure you are fully covered as a buyer if the inspection reveals major concerns. A home appraisal is different from a home inspection. An inspection is designed to give the buyer a clear picture of the condition that the home is in, while the appraisal is designed to let the lender know how much money the property is worth. The appraisal fee can range from $600 to $1,000 or even more than that, depending on your loan. You may be able to include this fee in your financing, but you should include this fee in your savings plan just to be safe. The mortgage lender will hire the appraisal and work with you to schedule it. Unlike a home inspection, you as the buyer do not pick the appraiser. The appraisal will confirm how much money the mortgage lender can extend a loan to you for based on the value of the property. If the appraisal comes in lower than the amount you're asking to borrow, you will either need to come up with more money to bridge the gap or potentially see if the seller is willing to negotiate. Before we get on to the fun part of closing day, we will pause again for questions.
We do have a question, and it is, why have interest rates remained relatively flat despite several rate cuts by the Federal Reserve?
So mortgage rates are actually based on the 10-year treasury. More line of credit variable rates are based on the prime rate, which the feds determine in rate cuts. So they're based on many different factors, but fixed mortgage rates are typically based on the 10-year treasury. No other questions?
No other questions.
Okay, perfect. And closing day, once you've gotten through all the paperwork, phone calls, inspection, appraisal, and gathered all the money you need, it's time for the exciting part, closing day. Leading up to closing day, you will receive some documents ahead of time to review that can help speed the process up a bit at the closing table. You'll want to review these documents closely and reach out to your realtor or lender immediately if something seems incorrect. Legally, you are required to be sent your closing disclosure 3 business days before you are scheduled to close. This document looks very similar to the loan estimate that you received in the beginning of the process, but this one shows the actual payment rate and closing costs rather than just an estimate. You will also want to confirm with your realtor the exact location to meet for closing and plan to arrive early. You can also request a final walkthrough of the home, which can be used to confirm the seller made any requested repairs, make sure the home is still in as good condition as it was before, and verifies that all agreed upon appliances remain in the home. Prior to closing day and receiving your keys, you will need to reach out to the utility companies to schedule all utilities to transfer to your name by the day you plan to take possession of the home. Even if your move-in will be delayed, you will still want to move utilities over as of the day the property is officially yours. You will also want to provide the town or city that you have moved to a copy of the deed that you will receive at closing so that they can update their records as well. You will also want to connect with your realtor and lender about what you need to bring with you to the closing table. This typically includes a valid photo ID for all borrowers and a certified cashier's check if you're not using a wire transfer for your closing costs and down payment. You're at another pause for questions.
No more questions at this time.
After you've signed more paperwork than you could have imagined, handed over a large sum of money, and got your keys, congratulations, you're officially a homeowner. The journey doesn't stop with walking in the front door for the first time. However, before we wrap up our time together, we want to share some keys to successful homeownership beyond the closing day. The first tip is to prioritize rebuilding your savings as soon as possible. If most of your savings went to down payment, closing costs, and moving expenses, it can be tempting to jump into renovation products and improvements, but pausing first to get some money tucked away for emergencies is recommended. As a homeowner, when an appliance breaks, you are responsible to fix or replace it versus being able to call a landlord. As a homeowner, you'll be responsible for repairs, maintenance, trash removal, snow removal, lawn and garden care, and pest control. It's also recommended to map out an annual home maintenance plan. We actually have a handy checklist that you can download to help keep track of the maintenance needs and dates that we'll include in the follow-up email. You may also need to purchase equipment to keep your property in top shape. Be sure to plan and budget for items such as lawnmowers, snow blowers, power tools, appliances. Again, as a homeowner, there are more possibilities for emergency expenses than as a renter. It's recommended to keep an emergency fund separate from other savings for things like a renovation or vacation. This ensures you have money tucked away for unexpected major expenses that won't be touched until needed. And as we discussed earlier, your mortgage payment may increase as your homeowner's insurance and property taxes change. As you revisit your budget from time to time, keep this in mind to be prepared for a potential increase in monthly payment. As you plan what repairs and improvements you want to make to your new home, prioritize any major concerns the home inspector found. These may not always be the most fun or cosmetically pleasing improvements, but they can be the most important to take care of first. You may also need to build up savings to take care of larger repairs, so having a plan for this can be helpful too. And the final key to successful homeownership is to always prioritize your mortgage. A foreclosure can begin as soon as 3 months after falling past due on your mortgage, so making this payment your top financial priority every month is strongly recommended. If you're ever concerned about making your mortgage payment, reach out to the mortgage company as soon as possible to discuss your options. There may be both short-term and long-term hardship options available, and the sooner you explore them, the better. And GreenPath is a nonprofit organization our financial institution partners with. They have more than 60 years of experience empowering people to lead financially healthy lives. GreenPath certified counselors can conduct a free confidential financial assessment with you. This involves taking a look at your budget with you and collaborating to develop an action plan to help you work toward your financial goals. GreenPath can also talk about other financial concerns or goals you have related to things like credit, housing, student loans, or debt. GreenPath offers a deep dive into the home buying process for those who want to take a closer look at their home buyer readiness. And thank you for attending our Keys to Home Buying webinar. We'll follow up with an email later today or tomorrow that has links to the resources we discussed today and the recording of today's webinar to watch again in the future or share with someone else who may be looking to purchase a home. If there are no other questions.
There are no other questions in the chat, but I did allow people to unmute themselves and come off to ask questions. Sometimes it's easier to have a conversation than it is to type it. So if you do have questions, feel free to unmute yourself and jump in with whatever you need to know. And if there's no questions, we really appreciate you being here, and we will have another webinar next month. I can't remember the exact date, I apologize, but I will have the information in the email, the follow-up, but it will be covering credit. So talking about your credit score, all of the different components that make up your credit score, which is a really good follow-up if you're in the early stages of being prepared to buy a home. Just making sure that your credit is in good shape before you start this process could be really helpful. And if there are no other questions, that is what we have for today. So thank you so much for being here. We really appreciate it.
Yes, thank you everyone. We appreciate your support and hope to see you at future webinars.